So today's book is for you if you are interested in stock market investments. This should be your first read if you want to gain an understanding on how stock market operates, what are different variables that have an impact on stocks, and how to make an informed decision when it comes to buying and selling stocks. So the book is called The Intelligent Investor. It was written by an American British economist, Benjamin Graham, in the year 1949. Since then, there have been various editions released for this book. That's why there is an important chapter in this book which covers more than 100 years of stock market investments. Another reason which skyrockets the importance of this book is the fact that it is recommended by the largest stock market investor, who is also the third richest person in the world, Warren Buffett, who read this book when he was only 12. Specifically, he recommends to read at least 2 chapters from this book. Chapter number 8, which is about market fluctuations, chapter number 20, which is about margin of safety. Do let me know in the comment section below if you want me to do a separate video on these 2 chapters. Do watch the video till end because I'm going to share with you the most important para from the book. Let's start the book review. So I'm going to discuss at least 5 main topics from the book I believe are more important. There is an interesting thing from the book that whenever a topic or a concept is discussed, it is always followed by a real life example. So it really helps you to clear the concept or the topic that is being discussed. That's why I will sincerely recommend you to read the book yourself and don't totally rely on my review. So the first topic from the book is about rules for common stock. So whenever you decide to buy a common stock, so what are the rules you have to keep in your mind? So there are 4 rules. The first one is to have limited diversification. It means that you should not keep all your money in just one stock or in so many stock you find it difficult to manage. A number which is recommended in the book is you should have investments in at least 10 companies' stocks, and it can go up to 30. It also depends on the amount of money, cash and capital that you have allocated for stocks investments. Rule number 2 is to select a prominent company. An example I'll give you here, that in Pakistan Stock Exchange PSX we have KSE All Index. Then there is another exchange which is called KSE 100, where you can see top 100 companies, and then there is another exchange which is called KSE 30, where you can see the top 30 companies. So you should be targeting your investments into those 30 companies which are prominent ones, which are the biggest players in the market. And those prominent companies should be conservatively financed. Now, what does that mean? The debt equity ratio of those companies should be a good one. That majority of the source of finance should be equity and not debt. Rule number 3 is the dividend payout. So there should be a long history of dividend payout from the company. What that explains is the liquidity position of a company is as important as profitability, and the frequency of dividend payout gives you an idea about liquidity position of the company. Rule number 4 is to impose a limit on the price of a share that you want to buy. So there should be a logical method used to determine the price of share. So what is recommended here is to buy a share at a price which is nearby its intrinsic value. What is intrinsic value? You'll get to know about it later in the video. The second topic that I'm going to discuss is the difference between investment and speculation. So as a stock market investor, you should have a clear understanding of what's the difference between investment and speculation. So investment means when you do your homework before buying a company's share. You have read the historical performance of the company. You have studied the financial statements of the company. You have a clear understanding of how the industry in general is operating, and you also have an understanding of how the economic indicators are performing. Another point to add here is that you also intend to hold that investment for a certain period of time, maybe for a couple of months or a couple of years maybe. Speculation, on the other hand, is about making short-term gains through buying and selling stocks. Now, nowhere in the book author says that speculation is bad. However, as suggested by the author, your capital allocated for speculation should not be more than 10% of your total capital. Topic number 3 from the book is to treat stock market as a person. Maybe you can name it as Mr. Market. So you have to study the mood of Mr. Market. If the mood of Mr. Market is good, then market will go up. All the share prices will go up, which is called a bull market. And if the mood is bad, then all the share prices will go down, and it is called bear market. Now there is a very simple rule you have to keep in your mind, that whenever prices are going up, that is the time when you have to sell your stock, and when the prices are going down, that's the time when you have to buy your stocks, not vice versa. Now topic number 4 is about margin of safety, which means that whenever you intend to buy a stock, so you should determine the right value, the right price at which you should buy it. The right price to buy a stock is the price which is, in ideal scenario, less than the intrinsic value of the stock or somewhere near to it. Now, intrinsic value can be explained and discussed in very detail, but a basic way to calculate the intrinsic value of a stock is by looking at its PE ratio, which is price to earnings ratio. So if the price of a stock is less than the PE ratio of the stock or is somewhere near to it, you can go for buying that stock. The final topic, topic number 5, is about IPOs, initial public offerings. It happens whenever a new company gets listed in stock market. A recommendation from the book is that you should not run after IPOs. Whenever IPO is done, it is done by the company in coordination with professional valuers. We call them merchant banks. And those merchant banks have been doing this for so many years, and they have so much experience into it. They have their own expertise about it. So it's highly unlikely that those banks will not give the company the best price to list in the stock market. So other than these 5 topics, there are so many other things this book has to offer. For example, to maintain a ratio between stocks investments and bonds investments. So you can also go for buying bonds from the companies listed in the stock market. The benefit of going for bonds is that the rate of return on bonds is fixed. That's a debt instrument. Now the recommended ratio is to have a 50-50% of investments in stocks and bonds, or if you are an aggressive investor or an enterprise investor, then you can go for a 75 and 25% ratio. Other than this, it also talks about January effect. Now what does that mean? That at the end of a year, majority of the investors, they try to sell off their investments so that they can take profits, and then at the beginning of next financial year they are going to buy new stocks. So it's highly likely that at the end of a financial year the prices will go down, and that's the time you have to buy your stocks, and you should sell them at the beginning of the next financial year. Other than this, there are so many other tips and tricks from the book. For example, Dow theory. So what does Dow theory mean and how it operates? So if you are into stock market investments, you should have an understanding of Dow theory. Then rate of inflation and its connection with share prices, you can also study about it. Dividend policies of the company, how they are determined, you can study about that. Investment funds, normally we call them mutual funds, so how they work. And especially if you don't have time to do stock market investments, maybe you can have a help from these investment funds. And there are so many other topics discussed in this book. That's why again I would recommend to read this book yourself. Now in the end of the video, I am going to share with you the self-claimed most important para from the book. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book and no more. Thus, the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is pervasively transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment.